This is the stock chart of Salesforce, a company that was once a high flyer, much beloved by the investor community. But over the last 5 years, something has changed. Something has broken in this story, and Salesforce is now considered a laggard, a has been. Back in 2020, Salesforce reached a stock price of $265. Today, the share price is lower than that. While the S&P 500 is up 94% over the past 5 years, and that's excluding dividends, Salesforce is only up 4%. If you take inflation into account, Salesforce actually lost investors' money over this time. But what I find curious is that despite the stock price not going anywhere in the past 5 years, the fundamentals of the company say a completely different story. Back in 2020, the revenues for Salesforce were 17 billion. Today, that has pretty much doubled to 37 billion. If we look at the one true measure of a company's profitability, the free cash flow per share, the story is quite similar. In 2020, investors got $2.30 for each share of Salesforce that they owned. Today, that number is at 9.62. So the revenues and free cash flows have exploded since 2020, yet the stock price is still at the same level. That can only mean one of two things. Either Salesforce was way overvalued back in 2020, or Salesforce is way undervalued today. Well, in life, nothing is black or white, and the reality is that it's probably a mix of both. But the main lesson here is that valuation matters. Salesforce was trading for a very high multiple back in 2020, and that multiple has been compressed over the past 5 years. The only thing we can say today that's 100% true, it's a fact, is that the risk associated with buying Salesforce stock is much lower today than it was back in 2020, simply due to valuation. And here I've made a list of Salesforce main competitors. And this is how the valuation for Salesforce compares. This number is very quick and dirty. It doesn't really tell you much without any context. After all, Oracle and Microsoft and Google are all investing incredible amounts into AI infrastructure. That's not the case for Salesforce. But overall, we can see a trend, and that trend is that Salesforce is trading at a deep discount compared to its peer group. So the main question we want to answer today is this market disrespecting Salesforce, or is all of this a well-deserved trim to Salesforce's valuation? Now, before we begin, make sure to like the video and subscribe. It really supports the channel. Also, if you like reading about this type of content, make sure to subscribe to the Signal newsletter. It's completely free. I'll leave the link in the comments below and also in the description of this video. Without further ado, let's begin. So, to put it simply, the boogeyman in the room for Salesforce is artificial intelligence. Salesforce moat today can be summarized in just a few words. Essentially, it owns the CRM database of its clients. If you're a Salesforce client, all of your important data lives on Salesforce. That's why it's incredibly hard to rip out Salesforce if you're an organization. And it gets even harder the larger you are as a company. And right now, investors are just afraid that AI will disrupt the traditional SaaS subscription model. For example, Adobe is going through a crisis of its own due to exactly the same narrative. This is a stock that historically has done amazingly well for its investors, but over the past 5 years, it is down 25%. But if we go back to Salesforce, there are three main reasons why investors are afraid that AI will disrupt this model. The first is that right now, Salesforce owns customer data. But what if that changes? What if the interface goes from Salesforce to an AI agent, and now all the customer data lives within an AI agent? On the other side of the coin, it's a very similar problem for Salesforce. There are other companies, other applications that hold a lot of customer data at the moment. Think about most big tech firms like Google or Microsoft. What if they, with the help of AI, add some CRM features to their product offerings to bypass Salesforce. Whether it's an AI agent from OpenAI or Anthropic, or whether it's a big tech company like Microsoft or Google, or whether it's a company that holds a lot of customer data like Snowflake or Databricks, if these companies manage to switch the interface from Salesforce to them, then all of a sudden, Salesforce's dashboard is rendered ineffective. Completely useless. The second big risk from AI is that Salesforce's features that are quite advanced at the moment get commoditized due to AI and become free for customers. Salesforce has some pretty advanced features. For example, lead scoring, pipeline management, or customer segmentation. Those are all rule based features. But with AI, it's possible to implement all of these features at a very low cost if you develop a good enough model. And now with AI, you can build any type of application really quickly. And so the fear is that an AI native competitor will be developed and bypass Salesforce once again. If a cheaper and good enough competitor came onto the market, maybe smaller businesses and medium sized businesses wouldn't feel the need to go to Salesforce and instead opt for the cheaper alternative and easier to use. Okay, the third and probably the biggest threat to Salesforce right now is that AI tools are becoming ubiquitous. And this doesn't even have to be AI for corporations. This is AI for individuals, personalized AI tools like ChatGPT. If every worker in your company is already paying a personal subscription of $20, $30 a month for a very powerful AI tool like ChatGPT that can already help you become very efficient, write emails very quickly, respond to messages, etc., what's the need for Salesforce's very expensive AI tools? Why would a manager at a large company decide to pay $300 per seat per individual in the team when each of them is paying $20 on their own and being just as effective? And as these companies become more effective and they hire less people, they need less people to do the same amount of work, Salesforce will make less money because, as it stands, the business model is to charge per seat. So if Salesforce sells for a division at a company where there's 1,000 workers, then Salesforce will be able to charge for 1,000 seats. You can see the problem here is that as that team of 1,000 people shrinks, Salesforce will be able to charge less unless they find another way of making money. But Salesforce is not standing still, as you can imagine. Right now, the company has two main defenses. Salesforce already owns the data layer. It's the incumbent. All the largest corporations in the world already have their data on Salesforce, and it's incredibly difficult to get rid of that, to change that. There are massive switching costs. So Salesforce already has that incumbent advantage. But Salesforce has another defense that is not just playing defense, it's also playing offense. The company's innovating. It's bringing AI to its core suite of products. All the standard stuff like email draft generation, notes summarizing, forecasting, transcript generation, customer support responses, all the basic stuff, all the stuff that everyone is already doing, Salesforce is implementing. So when Microsoft, Google, and all the other companies bring these products to market, customers have no incentive to switch to those because they're already using them at Salesforce. But Salesforce is doing more than just the basics. They're also bringing in complex AI tools that are very efficient, like Agentforce. These are autonomous AI agents that can complete multi-step tasks without any human input. For example, you receive an email from a customer. The AI agent enriches the data by pulling from LinkedIn, Google, other sources. Then they assign that lead to a specific sales rep, and then they even start drafting the email for the customer. So obviously, Salesforce is making a lot of sales teams a lot more efficient. And if we look at Salesforce's last earnings results, we can see just how well that adoption has been coming along. Here we can see that second quarter revenue was up 10% year over year. Subscription and support revenue was up 11% year over year. Remaining performance obligations up 11% year over year. Data cloud and AI annual recurring revenue up 120% year over year. This is a huge number. It's probably all from a very low base, so don't pay attention to this as much. Closed 12,500 deals since launching Agentforce. 40% of Data Cloud and Agentforce Q2 bookings came from existing customer expansion. So Salesforce's customers are the ones using Agentforce the most. And if we look at the very important full year 2026 guidance, we can see that revenue growth is approximately going to be 9%. Operating cash flow growth will be approximately 12 to 13%, and so will the free cash flow growth. So it seems that things aren't going so bad for Salesforce after all. It's like the stock price is giving us one story, and that's a reflection of investor sentiment. And then the data is giving us another story. Personally, I trust the data. This whole scenario kind of reminds me of Google a little bit. Up until very recently, everyone was very afraid for Google search. That's Google's most important business. It's Google's cash cow. Without search, Google isn't nearly as strong of a company. And obviously, the big threat for Google search was OpenAI, ChatGPT, and all these AI models. But that's not really reflected in the numbers. Google search is still growing year after year. And as it turns out, all it takes is one positive ruling by a judge on anti competitive measures for Google stock to just start firing to the upside. So, data is permanent. Investor sentiment can change on a whim. Always remember that. Okay, there's one last very important piece of this story. We cannot finish this video without talking about this. Salesforce used to have a reputation for overspending, lavish spending on events like Dreamforce, hiring U2 to perform concerts at this event, partnering with famous actors like Matthew McConaughey. All of that really changed in the last 2 years. And if you look at the data, it becomes quite obvious. The first hint is here in the operating margin. In the past 2 years, Salesforce finally became a profitable company. Of course, in the past 2 years, free cash flow also exploded. Mark Benioff, the CEO, just decided to turn on the taps of free cash flow. And all this free cash flow hasn't been used in a wasteful way. First, Salesforce started paying a dividend for the first time last year. So investors are now being paid just for holding Salesforce shares. And on top of that, the company is now buying back shares. This is unheard of for a company like Salesforce. Salesforce used to be dilutive, extremely dilutive. The share count used to go up 5, 6% year after year after year. And in the past 2 years, however, they've been buying back shares. As of the latest earnings report, they even increased the budget for the share buybacks. That means management probably thinks the share price is at a low point. When I input my assumptions into my total shareholder return calculator on rated A for Salesforce, assuming the buy price at today's price, a growth rate of 10% for the next 5 years, expected margin of 26%, expected shares outstanding in 5 years of 940 million, a terminal multiple of 25, the current dividend growth rate, and 100% of dividends reinvested, we get a total shareholder return of around 13% per year. This isn't anything to jump to the roof about, but it's still much better than the S&P's 7 to 9% average annual returns. So, as of today, Salesforce has a quality rating of A and a value rating of 80, which is really quite high. But what I will say is that maybe this is not a bad time to start buying. All right, that's it for this video, and I'll see you in the next one.